Welcome to another episode of Financial 15. We're talking fiscal policy today. What is it? Is it important? How does it impact the economy? Lots of great information. You definitely want to stick around.
Yeah, we constantly hear those terms: fiscal policy, monetary policy, the Fed, Bank of Canada. Getting a definition of all this is probably going to be a little clearer to help you understand how the government and how monetary policy works, as well as fiscal. And we should start with that today. Now, if you want to look at any of our videos, please go to our YouTube channel and subscribe. Lots of great content there. More on this, more on our back and forth Financial 15s. Also, like us on Facebook. Most importantly, visit our website at beckerorr.com. You will find blogs, you will find events, you will find everything else you need there for your financial well-being. But today, we want to talk about fiscal policy. Everybody's heard the term, but I don't think a lot of people know exactly what fiscal policy is and how it has an influence on your financial system going forward. Clint, how do we want to start? What is fiscal policy?
Let's start with the answer. Fiscal policy, it's government spending and tax decisions. It's the government spending and tax policy. That combination is fiscal policy. So really the video is over. We've answered the question. We know what fiscal policy is.
Good
Problem
stuff.
solved. Of course, it gets a little more complicated, a little more nuanced, but in a very high level, that's it. This is the government decision, government spending, government taxation. That is fiscal policy in a nutshell. It's a combination of those. So we'll do a little background here, though, to see how that came to be, because it hasn't always been this way, right? The government always didn't get involved in taxing and spending decisions to the same degree they do now. It changed. And what was the event that really was the catalyst here, Kevin? It was the Great Depression.
Yeah, the Great Depression is the big thing. Beforehand, it was always assumed that markets would self-correct themselves. There was never any government intervention needed to be able to do this. And this is all based largely, the fiscal policy, on British economist John Maynard Keynes' theories and the way they worked. The argument was that the economic recession, due to the drop in consumer spending and business investment. So, everything was going to correct. But we found that in the Great Recession, that didn't happen. You had interest rates still going up. You had a variety of other things going on. Fiscal policy had to come in. There was the belief that the government could stabilize the business cycle by doing a few things. And those two things basically were increasing their spending, so giving more and more money into the system to help, or raising or cutting taxes, depending on what was going on, to try and stimulate more growth in the economy. If you put more into taxes, less people are spending. If you cut people's taxes, more money to spend. So his theories were mainly developed, as we say, as a response to the Great Depression back in the 30s, and how things started to play out from there.
Absolutely. And we should mention fiscal policy is very political. You have politicians making the decisions here. So it's very much in the political realm. But that was kind of the underpinning, the starting. It was very much those Keynesian economics, and that you should have some government intervention to kind of regulate the economy so we don't get another Great Depression. Using that Keynesian logic, you really had two types of fiscal policy. The first one was expansionary fiscal policy. Expansionary fiscal policy is really when the government is trying to give a boost to the economy. Maybe the economy is in a recession or it's slowing down, and to regulate that, well, they increase their spending, right? So they might lower taxes to give more money in people's pockets so those folks spend more money, or they might just spend more themselves on different social programs or different ways they can influence the economy. So the expansionary fiscal policy is meant to give a boost to the economy. And usually, if we're looking deficits, surpluses, that kind of year-to-year budget for the government, normally expansionary fiscal policy is associated with deficits, meaning there's more money is going out than is coming in on the government budget, on those ledgers, right? So you have expansionary fiscal policy, the money is going out into the economy to try to give it a boost and expand what's happening. So I mentioned two there, Kevin. That was the first one. The second one is the opposite. It's contractionary fiscal policy.
You're right. It's a contractionary fiscal policy. And we've seen both of these examples pretty much in the last number of years. I mean, as you had the pandemic come out, tons of expansionary policy there, tons of government money going out, anything to deal with trying to get things there. Now what we're finding is a lot of the opposite, the contractionary fiscal policy. The economy's overheating. We have far too much inflation. What do we start to do? Well, you want to increase taxes possibly. Why do you want to increase taxes? Because you're going to take money out of the system. Thus, you're going to slow down the inflation. Or we're going to cut spending. We've already seen that. We've gone from quantitative easing to quantitative tightening. So we're not getting that anymore. So it's the government's attempt not to give more money. And as we say, usually a contractionary fiscal policy will result in deficit surpluses. So if we have spent, 20% of GDP, now maybe we're spending 5% of GDP, or we're gaining money one way or the other. So the contractionary is, again, more of the increasing taxes are really basically taking government money out of the system. That way we can stop an overheated economy and stop that inflation from going forward.
Yeah, and quick mention there, when I did the slide here, I meant to say budget surpluses. Deficit surpluses is an odd term. Normally it's a deficit or surplus, not both. So meant to be budget surpluses. So the idea, you're trying to contract fiscal policy, slow the economy while the government will be taking in more revenue and spending less. So it should be improving the balance sheet, improving the budget overall. And again, this is kind of the nuts and bolts version. We're looking at the Keynesian economics as kind of the starting point in these two very broad categories. Again, political actors make these decisions, so often it does very much become a political decision about what they believe the role of government would be and how they want to interact. But fiscal policy falls in that realm. So we'll take a quick look at kind of reality. We looked a little at the theory. Now, what has happened in the last 30 years? I'll make this a little larger, but this is the U.S. federal budget. This is the deficit or surplus done as a percentage of GDP. And you can see it's changed over the years, right, Kevin? You had smaller lines back in the 90s, early 2000s. Even you had some green on the screen, and then a much different approach the last 20 years.
Yeah, we've seen that there's been a lot more government spending to try and prop up a variety of things. I mean, as we say, coming out of the late 90s into the early 2000s, things looked really good. And then all of a sudden you had sort of the tech wreck in the 2000 fall, and there was more government spending. And when it just started to come back to a point where maybe you were going to get surpluses again in 06, 07, then you had the Great Recession that took everything down again. So as you've seen, it's sort of gone in cycles from that point. But we haven't gotten to the point yet where there's been less government spending than there has in collecting money to be able to deal with on the revenue side, at least in the U.S. federal side of the thing. So they have still been running some fairly significant deficits. And as a result, every time you get those sort of increases in percentages or interest rates, that's going to have an effect on what you want to do with this going forward. What does the Canadian side of this look like, Clint?
Yeah, I'll pull up the Canadian one in just a second here, but I should mention, I'm saying it's in the political arena. This goes across political parties when you go back this long. And as you mentioned, there's kind of an economic cycle here, right? So you have that run up late 90s, early 2000s, then you have the tech wreck, another nice stretch there. Then you had the 08 period, then another nice stretch. And then, of course, the pandemic, which was the biggest bar on the screen here, was 2020. And you'll notice a little bit of a similar trend, some differences, but a bit of a similar trend when I pull up the Canadian numbers here. Again, 2020 by far the biggest deficit there. This is a percentage of GDP, so the size as it relates to the size of the economy. But the green here is a little more pervasive. You have late 90s right up to mid 2000s. So you don't really have that tech wreck drop that we had in the US. Here, that kind of late 90s, early 2000s continues, which probably says more about the Canadian economy. It was a good time, high oil prices, commodities were running. That's helped Canada. And then you had the 08 drop, and then, of course, the big drop there with the pandemic. Anything you want to add to that, Kevin?
No, and it's the same thing as you see it. It's run over different political parties because we've gone through, at least in the Canadian side, liberal and conservative governments that have run both deficits and surpluses over those timeframes. So again, political parties, as we've mentioned before, do have an influence on it, but depending on how the economy is running, has a very big decision on how we're either increasing or lowering taxes or increasing or lowering spending, depending on what's going on from there.
That is true. That is true. So that was a quick one. That was a quick snapshot at fiscal policy. We'll be back again soon with another video where we look at monetary policy. Often they can work together. Sometimes they work in opposite directions because you have different decision makers. You have kind of different influences, but both of them can impact the economy. So you want to stay tuned. That'll be coming out again soon. Other questions, get a hold of us. Chatwithclintonkevin.com. You can see it on the bottom of your screen there. Would love to hear from you. Any parting comments for the folks, Kevin?
No, I'm going to do it quick and simple, just like you did. No, that's it. That's the beginning of our video. So no more questions. You know what fiscal policy is now. Please get in touch with us. We'll talk to you again soon.
Take care.